Please welcome Professor Rau.
Well, thank you all of you for coming on a day which is pretty awful, actually. So thank you very much. One of my friends, when I told him the title of this lecture, he said, trust but verify, that's the golden rule. And I said, well, yeah, we would like to verify all you like, but how can you verify? That's some of the things I'm going to be talking about today, when it's impossible for us to verify what they're actually saying. But this is the fourth lecture in this series of lectures I've been giving this year on the human side of finance. The first year, I talked about how technology changes the world of finance. Last year, I talked about classical finance, the big ideas of finance. And this year, I'm talking about how the last ideas I talked about last year actually don't really work amazingly well in the financial markets. So let's go back to what I was talking about last year. And like every class, every lecture, I talk about what is the core of finance. The core of finance is something very simple. It's about promises, right? The idea is always that somebody comes and says, I'm going to give you a lot of money in the future if you give me money today. That's the essence of finance. The question you're trying to answer is, how much should you pay for these promises? What is the value of this promise? Now, the series of lectures I had last year was talking about rational finance. How do you value these promises? And the answer there is, it depends on cash flows, it depends on risk, it depends on all these other things. However, this year, I'm talking about the human side of finance. This person is promising you a lot of things, but maybe he or she is lying to you. Right? If it is deliberate, which is fraud, or if there's an incomplete contract, which means, in other words, that there's something in the contract which is so obscure, the fine print, if you will, that allows them to take advantage of you. I'm going to give you examples of both, but today I'm going to talk about capital markets. Right? So, in particular, when I talk about capital markets, I'm going to be talking about a group of people whom I like to call money doctors. Right? So, what are money doctors? Well, money doctors are essentially anybody who advises you in the field of finance. So, and lots of leading investment managers and nearly all registered investment advisors do not say past performance is so good, let's show you future performance. What they talk about is trust, they talk about experience, they talk about dependability. Now, this gives you peace of mind as an investor. So if you don't know too much about finance, or you're too nervous or anxious to make your risky investments by yourself, these guys are offering you peace of mind. That term, money doctors, was actually coined by Janali Schleifer-Vishny in a paper which was published in Journal of Finance in 2015. But it's a very evocative term because, like doctors, they're supposed to say, you know what, we are analyzing complex things, like your health, in this case, your financial health for you, and we are guiding you to make the best decisions possible. So, who are these money doctors? Well, there are lots of them. For example, mutual funds. Right? There are also hedge funds. There are registered investment advisors. There are financial planners, wealth managers, brokers, fund of funds, even bank trust department, and in general, anybody who's giving investors confidence to take risks. That's the essence of a money doctor. So, what are the incentives of these money doctors? Well, the first incentive is straightforward, to help their clients. Right? I'll talk about each of this. The second incentive is to pander to your clients. For example, maybe your client wants to invest in a hot meme stock, like, for example, the Trump SPAC last year. Right? This was a SPAC with only thing it had was Trump's name. Should you invest in that? Or cryptocurrency, the Trump coin, or the Melania Trump coin. Should you tell your client, don't invest in that if they're really obsessed with investing in that? Should we pander to their desires? And the third possibility is rip off their clients. Now, the third one can be either on behalf of their clients. So, for example, the example I have here is Credit Lyonnais, because this is a personal example. When I started my PhD a long time ago, before several of you were probably born. But I was doing my PhD at a business school near Paris, INSEAD, and I went to the local Crédit Lyonnais office after my professors had told me all about investing in stocks and so on and so forth. They told me all about the rational principles of finance. So I went to Crédit Lyonnais, my bank at that time, and I said, these are the list of funds I'd like to invest in. And they said, sure, no problem, sign these papers over here. A week later, I get my statement, and I look at it. None of the funds I've asked for have they put me in. Right? They put me in a bunch of different funds. Now, I went back and I said, what's going on here? Why have you not put me in the ones I asked for? They said, no, these funds are much better. They're like your funds, but they're much better. What they didn't tell me was the other funds we had asked for were independent funds, so Crédit Lyonnais would get no money from them. But the funds that put me in, the equivalent funds, were Crédit Lyonnais funds, so they got all the fees from that one. So I was, at that time, as I said, a young and naive PhD student. So, I was a little upset. But gradually, as I learned more in my PhD, I became more and more upset. And eventually, the moment I graduated, I pulled everything out of Crédit Lyonnais, and I've never gone back since. But that's the idea of ripping clients off on behalf of your firms. But you can also rip them off for your own behalf, and I'll talk about some of that as well. Okay, before we go anywhere else, I have a confession to make, right? I was actually a money doctor at one point in time. So what did I do? I was in the Asian equities group for a company called Barclays Global Investors. Barclays Global Investors no longer exists. It was purchased by BlackRock. But I was in the Asian equities group, which meant I was looking at countries in Asia, so Pakistan, India, China, places like that. And what I was trying to do was to look for signals which would say which companies out here were undervalued and try to buy those companies before everybody else found out. So, for example, if you look at the news over yesterday and today, it's all about the Trump tariffs being placed on imports from Canada, Mexico, and China. Today, there was another article which said they paused the tariffs on Mexico for a month, whatever that means. You can never predict with Trump. But the idea is, if I can figure out ahead of time which companies are going to be more affected, which companies are going to be less affected, I can make money by buying the cheap companies ahead of everybody else. So in a sense, what you're doing is looking for something like this. So you have these flow of money there, and you have different news actions, and you see how the stock price reacts. The idea is, can you predict these events, how these events are going to impact the stock price? Now, this is ex post, this is easy to do. But ex ante, can you do this? There are some cases where there are clear stories. For example, this is the entire stock market between 2008 to 2010. Now, what's interesting about this graph? Well, that was the day I joined BGI. And literally, the day I joined BGI, the entire American market collapsed. Would you say that's my fault? Cause and effect? Well, maybe some of you think yes, maybe some of you think no. But for those of you who think, no, this is just a coincidence, let me point out a different line. That was the day I decided to become a professor again. So the day I arrive in the financial markets, it collapses. The day I leave the financial markets, the markets explode, right? And you know what they say in the Bond movies, right? Once this happens, twice is coincidence, third time is enemy action, so I'm waiting for a third time. I have not invested in the British market to any great detail, so that you can't blame that on me. Okay, so first let's start with the question of how do money doctors help their clients? So the idea is there are two ways they do this. One is what we call asset allocation. So the idea is there are a bunch of assets such as stocks, bonds, any other type of assets, gold, whatever. And the idea, pick an asset class which best helps your client. For example, maybe they're 75, 80 years old. They don't want the volatility of stocks, so you put them almost entirely in bonds. Don't put them in stocks. Or maybe they're very young and you want to say, I put them in stocks, but then there's the second problem, which is called the stock selection process. There are millions of stocks, thousands of stocks available. Which of those stocks is particularly good to buy? So that's a stock selection process, but it also works for bonds and everything else. So you have an asset allocation, the broad asset class. You have, within that asset class, what's the best kind of stock to buy. Now, the objective in all these cases is straightforward. The objective is you want to get the highest return for the minimum amount of risk to solve this portfolio allocation problem, what the client wants. They want high returns with as little risk as possible. The question is, how do you know that these people have done a good job? So the question in general we ask for is, do these mutual fund managers generate what we call alpha? Now, what is alpha? Well, this equation is, what this equation tells you is, you have the R over there. Those are the returns to the particular fund you're looking at. So RI is return to fund I. T is a time subscript. So you're saying return to Vanguard in January 2025. So I would be Vanguard, T would be January 2025. And you're saying that's by some model of returns, that's the expected return in January 2025, plus some extra, and that extra is alpha. Can they beat the benchmark is the question we're asking. And the person who first came up with this was a guy called Jensen. So he came up with something called Jensen's alpha. And he asked, do returns on mutual funds just reflect the benchmark risk, or do they generate something extra? Do they give you that alpha? He did this back in 1969, those days where we had no laptops, we had no ChatGPT, we had no computers. All he had was big mainframe computers at University of Rochester. And so what he did was, he did this with 115 mutual funds. A lot in those days because you had to do it with punch cards. So he had 115 punch cards over time, give them to the university mainframe computer, they would batch it, they would run it, and he came up with 115 different alphas to say, okay, what percentage of these alphas are positive and what are negative? And what he found was, on average, the alpha before expenses is negative. After expenses, it's even more negative. So what this graph is showing you is that blue line is the benchmark according to the capital asset pricing model. So that's the line which you expected to reach. Most of these funds don't even reach that benchmark. They're clustered below that benchmark. So, but one might argue that reaching that benchmark is a really difficult job. Why? Well, let's look at the number of hedge funds operating around the world. This is a graph taken from Preqin, which counts the number of hedge funds where they're based. And it turns out there are over 30,000 hedge funds around the world, all trying to achieve a positive alpha. Is 30,000 a big number? Well, let me put that into perspective. This is the number of stocks globally, is about 40,000. The number of hedge funds which are trying to get those number of stocks is about 30,000 of that. By comparison, the number of Starbucks around the world is 32,000. Right? There are more hedge funds than there are a number of Burger Kings and Taco Bells around the world. That's the sheer number of people who are all trying to beat their benchmarks. So the question we ask ourselves is, how do we beat our benchmark? How do we get that positive alpha? How do we know that these guys are actually outperforming? So one possibility is it depends on the benchmark. So what is the benchmark? Well, there's a different problem here, what we call tracking error. Right? The key is very simple. Suppose I pick my benchmark as, let's say, safe government bonds, but I'm actually holding very risky stocks. There's a good chance I'll be able to beat my benchmark. Like, there's a big difference between my benchmark and what I'm actually doing. It would be like if I was an Olympic athlete, I would be benchmarking myself against a 3-year-old baby. Right? So I'd say, yeah, look, I'm much better than that person. What you need to benchmark yourself is someone very similar to you. That means you're counting the tracking error between your benchmark and you. So to put it in a different way, let's say your benchmark is the FTSE 100, right? 100 stocks, which you're trying to pick. Now, what you want to do is pick another group of stocks within the FTSE 100, which happen to do better than the entire FTSE 100. You're picking the above average stocks in the FTSE 100. So that's tracking error, right? You're keeping it within that benchmark and yet beating the benchmark. Okay, so how do you, again, coming back in here, what you want is that difference between RIT and expected RIT. The RIT should be very, very close in holdings to the expected RIT, but still generate an alpha. So how do you minimize tracking error? It turns out there are two ways. Three ways. One is if you're a small fund. If you're a small fund, what do? You have to trade, right? So let's say you're tracking the S&P 500. A stock drops out of the S&P 500, is replaced by another stock. You have to immediately sell that particular stock, which has dropped out, and buy the stock which has been added on, right? Because you're tracking the S&P 500, so you have to try to replicate exactly that. Unfortunately, for a small fund, this is expensive because it's costing you money to buy and sell shares. For a larger company, like BlackRock, like BGI when I was there, it's much easier. Because what you do is you're offering hundreds of different funds with different objectives. So what do? You have a big internal market. You can take stocks from one portfolio, put them in another portfolio. You never actually do any trading. You're just rearranging stocks within your big internal market. That saves a lot of money, about 1%. But 1% on a $200 billion fund is quite a lot of money. The second thing you can do is set the benchmark itself. And I'm going to focus a little bit of that because not many people think about who sets that benchmark. Now, in general, in academics, the benchmark depends on what we call factor models. The classic, the old-fashioned one, the one I talked about last year, is something called the capital asset pricing model. And two people, Markowitz and Sharp, got a Nobel Prize for that. And the idea there was the return to anything is explained by sensitivity to the market portfolio, that term over there. The idea is, if something is just as risky as the market, it will earn returns off the market. If something is twice as risky as the market, that means the beta is 2, the market goes up 10%, you go up 20. But the market goes down 5%, you go down 10. So it's twice as risky as the market. On the other hand, if beta is less than 1, you're less sensitive to the market. So a utility company will not really be affected by the movements of the market. People don't drink more water or less water if the markets are up or down, right? Water consumption stays the same. So market goes up 10%, maybe the utility company goes up 1. The market goes down 10%, maybe the utility company goes down 1. It doesn't matter. It doesn't move very much. That was the basic model. Unfortunately, the problem with this basic model was when you tested it with the data, it didn't work. There seemed to be no relationship between beta and returns. So two people, Gene Farmer and Ken French, came up with a similar intuition, but they started adding 2 more factors. What were those factors? One factor was what they call SMB, and the other factor was HML. So HML is like a value factor. That means you're looking at companies which are value. That means they have high book values, low market values. People are undervaluing these companies. SMB is a size factor. What you're looking for are small companies that are risky, but they also have potential to make lots of money. So that's your sensitivity to those factors. Those are the betas which you're looking for. And this is a standard model in academics. Almost every paper you read will refer to the Farmer-French factors. That means they are pretty much the benchmark. So if you go to Vanguard, if you go to any of these large funds, you will see a grid which says size and value. So you can pick funds within that grid, right? Those grids are standard. Okay, so how did this model become so prevalent? Well, it turns out Gene Farmer also happened to win the Nobel Prize. So he runs a company called Dimensional Fund Advisors. He and Ken French both run it. And one of the nice things about running a hedge fund by the way, they don't cater to individuals. They cater only to institutions. The institutions will ask them, how do you know that's a benchmark? And you say, of course, this is Gene Farmer. He got the Nobel Prize. Are you questioning him? And you say, well, no, maybe not, right? So most people are too intimidated to question this benchmark. But there is, interestingly, a recent paper by Pat Aki, Adriana Robertson, and Mikhail Simonson, who actually wrote a paper which looked at how the benchmarks actually change over time. So what did they find? This is a recent paper. And what they find is they found non-trivial retroactive changes to the factors, and the changes have meaningful effects in a wide variety of situations. And there doesn't seem to be any consistent evidence that the changes are making the factors better. And apparently, the changes after the mid-60s appear to be totally uncorrelated with revisions to the underlying data. So these guys are changing the factors without changing the underlying data. What does that mean? Well, to understand why these factors became so important and so to academics, you can go to Ken French's website. So if you go to Ken French's website, that's from his website. It literally gives you every factor you need. So if you want to do a test, go to his website. He has the data. He has bivariate sorts on size, book to market, operating profitability, investments on size, book to market, whatever you want, univariate, multivariate. He's done everything for you. Literally, you want to run your regression, pull the data out, run the regression, and you're done. And it's all free. Right? So for an academic, nothing better than free, because we don't really have that much money, right? So we take what is free. So this is our benchmark. Now the benchmark itself, if you go to his website, he has all these details about how they construct it, best academic tradition, but he also says, we transition from using a proprietary links between CRISP and Copycat data to those provided by CRISP. For those of you who know this, CRISP stands for the Center for Research on Security Prices, and it's held at the University of Chicago, which coincidentally happens to be where Gene Farmer works. Copycat is not managed by the University of Chicago. It's an independent firm managed by Standard & Poor's. So they're now going only with the CRISP data, which may be better, but it's also data that they control. But what Aki, Robertson, and Simonson showed was interesting. So what I have on this graph is two lines here. This should, by the way, the upper line should be red, and the lower line is yellow. What it is, if you notice, is if you put in $1, what does the value of the $1 grow till 2010? Well, it turns out if you had used the 2005 vintage of Farmer French factors, it would have grown to about $35. If you use the 2022 vintage, it goes to well above 40. Why? Turns out that there's a lot of stuff happening in the 1960s where they keep changing the factors, which means that if you download the factors in 2002, the same factors for the same year will be different in 2003. And a lot of changes happened here as well. Okay, so how do Farmer and French explain this? Well, they say, well, Dimensional Fund Advisor Research Group began helping with this update, and under our guidance, they produced the monthly updates, blah, blah, blah. So, but why is this important to DFA? Well, remember, the benchmark is value. So, but what's the problem with value? Well, unfortunately, value has not been doing too well over the last 20 years. If you bought value stocks, your performance sucks. That's a technical term. So, and they talk about it, and they say, well, this is an extreme outlier. This is not true if you really look at the data. And if you look at the data now, it looks like the growth in value, that's the growth is a dark blue, the value is a light blue, and they say, look, over the past year, we see this is a really, value, it looks like it's done worse, but it's done, this is because of this outlier here, only in the last few years. So, that means, think about yourself, right? You go to your investment advisor in May 2012, and you say, look, I want a mutual fund. Give me a mutual fund. And the mutual fund says that the 5 largest actively managed funds according to assets under management, and tell me which fund is the best. So the fund manager basically the advisor downloads the Farmer French factors for the previous years, 2007 to 2011, right? And looks at the performance. And on the basis of that, he says, go to Fund A. Fund A does easily the best among all the other funds you're looking at. Fine. And now you go on a few more years, and you find Fund A is not doing that well. So in 2017, you go to a new fund advisor, and you say, hey, look, this guy put me into this fund. Is this really the right thing? He said, when did he put you in? Oh, May 2012, right? This is fine. I'll replicate the analysis. So fund advisor 2 goes back, pulls the same data to 2007 to 2011, exactly the same data that the previous fund advisor did. It runs exactly the same regressions. Everything is the same. What do they find? He finds that, in fact, Fund B has done phenomenal, would have been the right fund to use. So if you do the same analysis for these years using that data, Fund B would have been better. If you had done the same analysis using the same data, Fund A would have been done better. The benchmark is changing without telling you that it's changing. Okay, but even if the benchmark is correct, what else can be the problem? Well, here's an article from the Wall Street Journal, which talks about how funds report their returns. In particular, they talk about 5-year returns. The interesting thing about 5-year returns is that in 2002, there was a bear market after the end of the dot-com bubble. And unfortunately, if you're reporting 5-year returns in 2003, 2002 is right there. Until 2007, when you no longer have to report the 2002 terrible period. What that means is, in 2007, your performance suddenly looks better. But it's not because it is really better. It's because the really bad 2002 number has dropped off. So, as an example, this is what Putnam New Opportunities A looks like, minus 4.88%. And then, after you take that year off, 2005, 2006, 1 year drop off, performance dramatically improves. And a lot of these guys say, oh, I really am anxious to roll off that quarter because, I took a big position at Delphia Communications Corp, which went for bankrupt, so I really need to get out of this. Anyway, so what do mutual funds have to do? They have to report their holding period returns over standardized intervals. The reason the government forces you to do this is because otherwise you cherry pick the period of time over which you report your performance. You say, I'm the best fund if you look at 4 years, 11 months, and 2 days. Right? You cherry pick that and you give that. So the government says, you can't do this. You have to give me standardized, right? So 1 year is compulsory, but then you can report 3 years, 5 years, and so on. People love the 5 years because that's really, a long period of time. Anyway, the point is, over time, those negative returns disappear. And the question is, what do people react to? Do they react to the new performance, or do they actually get fooled by that stale performance number dropping off? Let's look at that. So what we have here is 5 quarters. And you have a really terrible -5 period here. And over here, a not so bad -1 being added on. So this is the new information. That's the old information that's dropping off. So if you take only the last 4 quarters, you have a return of 8%. That's $1 at 3%, 4%, 5%, and this really bad -4%. If you take the next period over, the 5 drops off, replaced here, and the 2 is added on. So the only thing that's different, this and this. So effectively, what you have is the holding period returns are only a function of the new returns added on and the old return that drops off. Everything else is the same. So in one of my papers, I ran a regression on this. I basically said, OK, let's control for the new return. And let's see what's the magnitude of the end return that drops off. What you would expect is a negative relationship. That means if a really bad return drops off, big increase in flows. If a really good return drops off, big decrease in flows. Negative relationship between the two. And that's exactly what we found. Right? Notice that the worst performance is right T-13 T minus 37, and T minus 61. It dominates all the other periods. Basically, that's exactly the 1 year, 3 year, and 5 year returns dropping off. You have a massive increase in flows on the other side. Now, what's interesting about this is, why do investors fall for this? Well, you can't really blame them. The key is, mutual funds do not have to actually advertise the return. They can if they want to, and if they do that, they have to report standardized intervals, but they don't have to. So if they're facing a period which the returns are absolutely wonderful, that's the kind of ad you see. Look at our returns, they're so wonderful, 1 year, 3 year, 5 years. If they're facing a point in time when the performance isn't quite so wonderful, they'll put out an ad like this. Not a single number anywhere in that ad. Right? It's like, we are a wonderful fund, but I'm not going to show any performance because it sucks. Okay, well, but maybe, you and I, we're looking for this kind of stuff. Maybe we can't find the smart money doctors. Who are the smart money doctors? Maybe the best people to find it are other doctors. Right? So you think about, for me, as an example, as a professor, I walk into my class. How do I know who's the smartest student in my class? Well, it's easy. I just look for the person from whom the other students are copying their homework. Right? So I may not know who the smartest kid is, but all the kids know who the smartest kid is. Right? Same idea here. So maybe other mutual fund managers can detect the superior mutual fund managers. So maybe they hang out in bars and like, you think I'm good? You should see that guy. He's amazing. Maybe they hang out in beers, have beers, and talk about mutual fund manager gods. Answer is unfortunately not. We actually did this analysis, and in one of my papers, we looked at over 4,000 mutual funds, and we looked at every single holding they had, and we identified what we called copycat funds. So copycat funds were doing exactly what the other funds were doing, but with 1 quarter lag. Fund A buys IBM, these guys buy IBM just 1 quarter later. They sell Microsoft, this guy sells Microsoft 1 quarter later. And we found quite a few of them. So how did these guys pick their funds? If they really knew who the smart guys were, you would expect the smart guys being copied would perform really well. No, they didn't. These guys basically picked the other funds on the basis of past performance, just the same as any of us. Guys who have done really well in the past were copied. Guys that have done really badly in the past were not copied, but that had no impact on future performance. And there's another thing. There's also survivorship bias in strategies. So how do you actually launch a mutual fund strategy? The idea is straightforward, right? So I did this when I was at BGI. You download a whole bunch of data. You run a whole bunch of tests on that data. You develop a trading algorithm. You backtest against historic data. And then you finally implement it through a brokerage or platform, and then you can monitor, tweak, or swap it. The thing which we don't tell people is that there are 2 things going on. So this here is when the fund opens. This line on the left-hand side, the lower line going up, is the total net assets of the company. Notice what's happening here. It's 0 because the fund is not open. The fund does phenomenally well because the inflow is huge. But why is the inflow so huge? Because the performance is amazing. But what we don't tell you is that that's not the only strategy I tried. I tried 20 strategies. 19 of them didn't work. And I never tell you about the 19 that didn't work. I only tell you about the one that did. That one. So people look at that and say, wow, this is an amazing strategy. Let's give these guys lots of money, which people do. And unfortunately, mean reversion says, if they're done well by luck, luck turns. And so we see they're not doing that well later on. Okay, but there's another way also of beating your benchmark. Well, let's suppose you go to your fund manager. Suppose you're one of these guys. You want to do a fund strategy, which is telling you exactly how to beat the market. How do you do this? Well, the answer is straightforward. you go to your manager, you say, I have the strategy, I tested it every which way I can, the strategy is solid. The manager says, okay, but we have another 100 strategies. So how correlated is your strategy with all the 100? If it's exactly the same as those strategies, you're not really adding any value. We're already implementing the other 100 strategies. So I want to test how closely related you are to all these 100. That's step one. If you're too closely related, I might even downweight you. I might give you a negative weight because you're too closely related to all the other things you're doing. So what do? You say, fine, go ahead and test my strategy against all the 100 strategies. And then, while your manager is not watching, you kneecap all the other strategies. How do you mean kneecap the other strategies? Well, this actually did happen. Turns out that this guy here, this researcher, Jian Wu, was trying to boost his compensation. So it turns out that there was a second spreadsheet. First was the spreadsheet with the strategies. Nobody's allowed to touch that. But there's a second spreadsheet which gave the weights to the machine, which was testing how close these strategies were together, what weight to put on each strategy. And what this guy did, and the second spreadsheet could be modified by the traders. The first one couldn't. Once the strategies were in, they were locked in, the traders couldn't touch that. But the second one could. Well, it was also checked, but it was checked by the IT people who didn't know finance. The IT people just wanted to make sure the guy's not putting a 0 where there should be 1 or whatever, right? They didn't know in finance. So what this guy did was to basically handicap all the other strategies by putting in really bad weights and increase the weight on his own strategy. So it looked like he was generating a lot of value because he had told the machine that ignore all these other guys over here. He was caught and, basically he got about $620 million of unexpected gains and losses because of that strategy. Anyway, so that's the first one. That's about even trying to help your clients can create all sorts of problems. Right? But how about pandering to your clients? Well, the easiest way to think about this is something called, what do clients want, is something called meme stocks. So meme stocks are particularly in the news these days, and lots of examples, but I'm just going to give you one, GameStop. So what was GameStop? GameStop was a company that was selling the ability to play video games in, video game houses, like warehouses, big thing with lots of machines and playing. Unfortunately, they were doing this in 2016, right, 2019, and this is, by the way, August 2019, they were already doing badly, right? Nobody actually was going to big places to play video games together. They were downloading the games to your phone at home, they were playing it at home. They were not going to play it in big warehouses. And then COVID hit, right? If you didn't want to go there, outside COVID, what makes you think you want to hang out with a bunch of strangers to play video games on your machine? Nobody was doing it. So GameStop was in big trouble. In fact, it showed up, right? So you can look at the performance. It was right there. So the first two numbers are what I'm focusing on right now, right? The 1st to the 15th of January. It was doing really badly. And in general, it was claiming it was missing earning estimate and so on and so forth. Terrible news. So what did people do? They said, this is one of the worst companies we have seen. We're going to short it. That means we're going to sell shares that we don't have. We're going to borrow shares from other people and sell them, hoping the price will go down. Then we'll make money by buying them back cheap and returning it to the people we borrowed it from. Great. Right? This is the percentage of short interest. And you can note till January, nearly 100% of the stock had been shorted. Everybody was selling this, thinking it was a horrible, horrible stock. Okay, so then how do you short the stock? Well, the process is straightforward. You are the owner of a stock, but you don't actually have the stock, right? How many of you actually see your share certificates? Unless you're really, really old, like me, you won't see your share certificates. They're actually held by owner of record, who is a mutual fund or a custodian, not you. Yeah, you have a line item in your phone on your app, but you do not see your physical certificates. So it's held by somebody else. Anyway, the securities lender will take those shares from the custodian and lend it to the borrower or the short seller. In return, the borrower or the short seller will post collateral, right? About 102% of that value of the shares they have borrowed, and that will be put into a collateral pool, cash, treasuries, mortgage-backed securities, whatever. The collateral pool earns money, returns. You give some of those back as a rebate, and you give some back to the owner of record as fees. So that's the shorting process, right? Fine. So what happened with GameStop? January 8, 1769, the price for GameStop was 1769. January 11, the price went up a little bit because there was news that Ryan Cohen, who's the founder of Chewy.com, as one of the largest stakeholders of the company, had decided to appoint new directors to the board. Right? But the sales were terrible. The sales were 3.1% drop year over year, and so on. The price went a little higher, 1995, January 12th. January 13th, it turns out that the price jumped to 31.40, right? From 1995 to 31.40, almost double in one day. What happened? Because at this point, a lot of shareholders had sold it short. Remember, they were gambling the price would come down, but it didn't come down. It went up a little bit. So what these guys were doing was buying back the shares quickly before they went up in price even further. So the price, that caused the price to go up. It was about 31.40. But at January 15, the price was 35.50. And at that time, one guy at a company called Citron Research tweeted, tomorrow morning at 11:30, Citron will live stream the 5 reasons that GameStop buyers at these levels are the suckers at this poker game. The stock will be back at $20 fast. We understand short interest better than you, and we'll explain. Right? So this is the essential tweet they put up. So what happened? Well, they gave 5 reasons at their live stream. And one was, they're saying this is a short squeeze. There's no short squeeze going on. These guys are not going to buy back their shares. Second, numbers don't lie. GameStop is a hardware sale in the industry. Forget it. These guys are losing to Amazon, Best Buy, Target, Walmart, because people are not going into exchange the old disc anymore, or old games for new games. This market model, the business model is dead. They also said valuations matter. This is not Tesla. This is a retailer. Who's on the other side of the trade? This is, the people who are doing this are idiots. There are people ordering pizza to my house, signing me up for Tinder, or doing all the quick things, trying to hack my Twitter account. These guys are all idiots. And it says, your company can become your biggest enemy. Don't trust any of this stuff. So what do you think happened? Well, it turns out the live stream event was actually aborted because someone hacked into Twitter and shut them down. They live bombed them. And the price went up a little higher, right? So it went to $43. He predicted the stock would drop to $20. And to make more money, he sold call options on the stock, which allow people to buy the stock at a fixed price. All good. Except that Reddit decided that this guy was an idiot. Calling them idiots, he's an idiot. So they decided to flood the chat room with diamonds, rocket emojis, and obscenities. Calls a buy. The price went to $65. Then it went to $147. Right? And so basically, the trade was halted multiple times due to volatility. And after hours, Elon Musk tweeted one word, game stunk. What happened? The price jumped even more. Right? So at that time, this is Citron's Andrew left. He says, look, we can't afford this anymore. So he exited the game, making 100% loss on his investment. Right? So in general, what do you think GameStop should have done? It's a company with no business prospects. The price is abruptly much higher than before. What do you think it should do? Well, issued more shares. And that's exactly what they did. They issued 3.5 million shares more. The people are willing to pay $149 for this piece of junk. No problem. We're happy to sell it to them. And so that was the offering. 3.5 million shares were offered. But what about the CEO? What do you think the CEO of the company should do? He stepped down right away. Right? He basically said, guys, it was 8.94 when he joined. On April 19, 2 years later, the stock closed at $164. That's nearly 1,700% return. He said, I have done my job as a CEO. And of course, he earned millions on his way out, right? So, and a lot of other GameStop executives said, you know what? We're out of here. We got the money. So they all cashed in their options and they left. This is the great meme stock cycle. So Matt Levine at Bloomberg talks about it in a very funny way. He says, there's a company, and bad things happen. It gets criticized for misleading investors about federal investigations. It operates movie theaters like AMC that are shut during a pandemic. It operates video game stores and malls as games shift to being online, like GameStop. It literally files for bankruptcy, like Hertz. The stock goes down. Investors sell it, thinking it is further to go. But for some reason, investors on Reddit decide that it's actually undervalued. The short sellers are evil and immoral and must be punished. And punishing the short sellers will cause the stock to rocket to the moon, and it'll all be pretty funny. And that's exactly what they do. They buy the stock, short sellers capitulate, stock goes up. The stock goes up to way, way higher than it ever was or any point in the company's history. And any time people say it's not justified by economic fundamentals, how can this stock be worth so much money? Well, no problem. Reddit is even more annoyed. Anything slightly critical, they rush to buy stocks and call options, which force the price to go up even more. Right? So let's take some examples. So Clover Health, under investigation by the SEC after short seller report, basically they said, this culture is rooted in deception, and so on and so forth. And he himself, of course, the CEO said, it's rife with ad hominem attacks, sweeping inaccuracies, and gross mischaracterizations. What happened? A roar to record as short sellers got burned. Eventually, basically, in this particular case, the surges, this is what happened to the share price of Clover, as you can see, crashing. At this point, it starts shooting after the allegations come out. Right? But that's not the only one. If you're really smart, like the CEO of GameStop, the CEO of AMC, you lean into it. So what did he do? Well, it turns out that he had a Zoom interview over there, a YouTube interview, and he accidentally knocked, I don't know if it was accidental, but he accidentally knocked the camera off there, and he noticed that he was not wearing pants. Right? This is the CEO of the company. He wasn't wearing pants. Right? What happened? The stock price jumped. So, wow, look at this guy. Chutzpah. He's not wearing pants. Amazing. Let's buy the shares. Right? And he lent into it. So he's giving dividends and free popcorn if you buy his shares of his company. And people started flooding it, right? So they call him the ape father. This is a thing. He put him on Avatar, or even that. Right? So these are examples. Anyway, the problem is you cannot predict this stuff. So it happens in the UK that Cineworld basically tried to become a meme stock. They said, come on, guys, you rescue us, you rescued AMC. Unfortunately, nobody bothered about it. It was apparently not meme-worthy enough. So very difficult to predict. So Cineworld didn't work. But there's always somebody who will give you what you want. So talk about pandering. If you want these kind of stocks, no worries. There is a social media sentiment ETF to launch in wake of the Reddit rebellion. So these guys are apparently going to be checking Reddit all the time to see any stocks which might take off, which have no relation to valuation. They will buy it for you. You want it? You can get it. So last part, how do money doctors rip off their clients? Well, we all know lots of ways, right? I mean, this is a very open field. But I'm going to give you an interesting new way. This is called cherry picking. What does cherry picking mean? Suppose you operate two funds, a good fund and a bad fund, right? Or we call it a dumb fund. Okay? So you place trades in the morning without allocating them to a specific fund. Okay? Then you observe the performance by the end of the day. The stocks that did well, you give them to the good fund. The stock trades that did badly, you give them to the bad fund. Why? Well, it turns out that the good fund looks really good because you're looking at hindsight bias, right? You know what stocks went up, they got into the good fund. And you charge high fees for this fund. Maybe you do this for favored investors. You might even have your own money in that fund. But what about the bad fund? Well, these are retail investors. So retail investors don't pay that much attention anyway, right? So they won't even notice. It looks bad, but maybe they won't notice. By the way, this is illegal, right? But that doesn't stop people. This is what Leach was claimed to have done when looking at, he shunted $600 million to basically his favorite portfolios. So he was sued by the government for doing that. Sometimes that doesn't work. So for example, OZ Media was trying to Goldman Sachs was trying to put a $40 million in a company called OZ Media, which is a digital media company. And as part of it, these guys said, look, a lot of people are watching us on YouTube, just like the people right here, right? So lots of hopeful YouTube viewers. But the point was that these guys were trying to raise money on the sheer number of YouTube videos, viewers who are watching the YouTube videos. The point was they had arranged a Zoom video conference between Goldman Sachs and YouTube. And Alex Piper, who was the head of YouTube Originals, was supposed to call in from YouTube and say, these guys are amazing. Look at how many views they have on their YouTube videos. So unfortunately, Alex Piper was running late. He apologized to the Goldman Sachs team, saying, let's move this to a conference call. I can't talk on Zoom right now because I'm having difficulty logging in. Fine. On a conference call, he started talking about it. He said, this is an amazing company. Look at the sheer number of views on the YouTube videos. But the Goldman Sachs guys thought the voice sounded strange. It didn't sound like a human being. So they called him. So someone reached out to Piper, not through the official email address which had been put on the conference call notes, but through a personal address. And the Piper said, I have no idea. I haven't talked to you guys. It turns out that this co-founder and chief operating officer, Ozzy, had digitally altered his voice and pretended to be Piper talking to, Goldman Sachs, raising the money. But that's just not the only one. The other example, so the startup founder who sold an AI chatbot to schools was charged with fraud. And this one I particularly like because they found this company was called All Here, and they were doing the financial statements, and they were showing it to the investors. And people found a disparity between the outlook and the actual finances while the woman is talking. So what did she do? They confronted her. While she was talking, she created an email address and sent fake financial information from her email address, which she claimed had come from an independent financial consultant to the company. Right? She was doing, I've got to say, I'm very impressed, right? I'm not approved, but I am impressed. Right? Sometimes it works. My favorite example is Wells Fargo. So how many of you have bought foreign exchange from a bank? Anybody? Yeah, several. Excellent. So let me introduce you to Wells Fargo. What does Wells Fargo do? Well, Wells Fargo, it turns out, makes up numbers all the time. At least they did in this case. It agreed to charge customers, a spread of 25 basis points on certain foreign exchange trade, but the customer wouldn't know. So they would actually charge 30 to 35. Right? Or they said the bank was charging the customer 15 basis points. They actually charged 18. Seems very small, but that's a lot of money if you're buying it. Right? The favorite one is the big figure trick. So the big figure trick is, let's suppose the correct price is $1.0123. So while they're typing in the code, they don't type in 1.0123, they type 1.0213. They switch the numbers. Instead of 1.2, it becomes 2.1. And so it takes an additional 89 basis points from the customer. If they actually caught the error, they say, oh, it is a typo. 1, 2, 2, 1, 1. But my favorite example here was what they call the B-Swift Pinata. What the B-Swift Pinata was, if you make an order during the day, but you do this on an incoming wire transfer, the customer doesn't know when the wire arrived. So what you do is, you select the best price to the bank and the worst price to the customer all the way until the end of the day. Because you say, it came at 4 o'clock. You don't say it came at 11 o'clock and the trade then was very good. No, it came in, you don't know exactly when the timing is. Right? So this is a problem. You cherry pick the right amount there. And of course, that's not the only case with Wells Fargo. They basically had to pay about $100 million fine to the CFPB for creating basically fake accounts. So what that meant was, you go to Wells Fargo, and you have a bank account. They open a second bank account in your name, right? They don't tell you about the second bank account because they're given bonuses for the sheer number of accounts which are actually opened in the bank. So in this particular case, they would obtain a debit card number and set the PIN to 0000. And to bypass computer prompts requiring customer contact information, they would put in 1234@wellsfargo.com, no name at wellsfargo.com, or none at wellsfargo.com. I mean, it's an email address. It just is a fake email address. But the customer never knew that they have multiple bank accounts open in their name and multiple credit cards and debit cards opened in their name. Anyway, the overall conclusion from all this is very straightforward. Right? Money doctors are basically selling you financial instruments and ask you to rely on their trust, experience, and dependability. That's supposed to give you peace of mind. So I've talked about 3 ways. I've talked about money doctors basically helping you. They make you look like they're delivering performance when they actually may not be. They can pander to you, sell you anything you want to buy, even if it's bad for you. Think of it like going to your doctor and you say, I want to be healthy, but I really like dessert. No problem, the doctor says. Have 3. It's really, if I own shares in a dessert company, I'll direct you to my company and say, those are really good for you. And finally, of course, they can rip you off because you do not pay attention to what you are buying. Right? So when you ask the question, should you participate in these kind of financial markets? I saw this article in the Wall Street Journal about last week. It says, private markets are reserved for the rich. Should a test let you in? At the moment, you have to be what's called an accredited investor. That means you have to have enough money that they say you're smart enough to deal with the financial markets. But now they're saying you can have a test. The test, right now, you need to have $1 million in net assets, $200,000 in yearly income, or $300,000 for joint income. But now you can take a test. Say, do you understand what an option is? Do you understand all the stuff? And if you can take the test, fine. You can participate in the financial markets. Who are the people who are pushing this regulatory change? It's the financial market institutions. They want people who think they are smart. Right? The smarter you think you are, the better a customer you are for them. Right? And that's what I want to leave you with, which is, if you venture into the financial markets, you have to be very careful on everything which can happen to your money. Okay? All right, let's stop here. Thank you.